Most people try to guess the tops and the bottoms, but what if we could measure them? Is there a way to figure out when the market is actually overbought or oversold? And how well do those trading signals work? Let's have a look at the data most people are not considering. Let's try to figure out whether or not there's a way to time the market better than just using feelings, than just using the gut feel. Now, there's a good chance that you've heard of this indicator here, the RSI, the relative strength indicator. It's a very popular approach to try to figure out when the market might be too expensive, so the RSI is very high, or when it might be rather cheap and the RSI is low. This is the daily relative strength indicator, and it has the default settings, as in a 14-day length with the extremes being marked at 70 and at 30. It looks like this indicator works pretty well for the medium term, right? We just sell whenever the RSI is high, we buy when the RSI is low. But how well does it actually work? Should we pay attention to signals like this? Should we sell over here and should we buy over here? Should we then sell again over here and buy over here? I have run the numbers using the new premium platform Bitcoin Strategy Analytics. This is where we can do several back tests and try to figure out how well a certain strategy works. And this is what we're going to discuss in this video here, the daily relative strength indicator as a predictor of future returns. We use our standard settings. And so the first question we should ask ourselves is, for how long should we hold a position, right? Let's say we buy when the RSI is low. Should we hold for 5 days, for 10 days, for 100 days? How much do we have to look in the future in order to get some return out of a signal? What we see here on the y-axis, that is R squared. I'm going to talk more about that measure in a second. What we see on the x-axis, that's the number of forward days. So when we get a signal with the RSI and we check all the prior signals in Bitcoin's history, at least since 2018. When we look at how much do those RSI predictions correlate with those future returns, the best R squared, the best explanation of future returns is at the 81-day mark. So the idea is that the best signals for future returns come for the next 81 days. When we buy now and we look at the future returns, the best explanation is after 81 days. We should buy or sell and then hold that position, so the long position or the short position, for 81 days. That's the best way historically to use the 14-day relative strength index. So here's the data. It starts on the 1st of January 2018. It goes to the middle of March of this year. And we do include some trading fees here as well, 0.05%. Why did I take 2018 as a cutoff? That's because I believe that's a point in time where Bitcoin had a major inflection point. This here is the number of active addresses on the Bitcoin network. And it continued to grow up until 2018. We subsequently had a bear market in Bitcoin, right? We went from 20K all the way down to 3.5K. But even after the price continued to recover, the number of active addresses didn't really grow. When we look at Bitcoin relative to technology stocks, also since 2018, we don't necessarily see that much more outperformance anymore. Before that, Bitcoin outgrew technology stocks very clearly. This is Bitcoin relative to gold. Again, since 2018, the nature of Bitcoin has changed. And because of that, I think the beginning of 2018 is a good reference point for any backtested trading strategy. That's why we take the 1st of January 2018. And so let's dive into the results. This here shows the RSI value on the x-axis, right? It goes from 0 to 100. And on the y-axis, we see the log returns for the next 81 days. Again, we take 81 days because that's historically the highest R square. That's where the RSI was the most successful as a predictor of future returns. So what does this show us? This orange line, that's a regression line. And if we had an R square of 1, then every single dot would be directly on the line. If we've got an R square of 0, then all the dots would just be randomly across the scatter plot. But because we've got the maximum R square here, they tend to be somewhat around the regression line. But of course, there is a lot of noise. We are looking at daily returns in the end. The thresholds are over here, right? The 30 RSI and the 70 RSI. That corresponds with those thresholds over here. And it gives us an interesting first insight, something that's counterintuitive. The RSI is very often interpreted as a buying and a selling signal, as in when the RSI is low, then everything is oversold. Then we should rather buy the dip. When the RSI is very high, then it's overbought. The price has appreciated that quickly that we might want to sell. But what this chart here is showing is that there is a positive correlation between the RSI and the future price development in the next 81 days. So when the RSI is high, the price tends to continue to rise. When the RSI is low, the price tends to continue to go down. This is the exact opposite, right? We are not oversold when we are very low on the RSI. We rather continue to sell further. And when we are high, we rather continue to go up. Now the question is there potentially a skewness in the data here? Is one signal worth more than another one? As in, should we bet on falling prices when we are low on the RSI, or is it better to bet on rising prices when we are high on the RSI? Which signal here is stronger, the high RSI or the low RSI? And again, we use the signal here in the exact opposite way of what most people do, right? We would be buying when it's high, we would be selling when it's low. And we do that because of the positive correlation between future returns and the RSI value. And so here are the answers. Have a look at this. When we are in oversold territory, so when the RSI is low, the mean return in the subsequent 81 days was 10.4%. The median return was 9.6%. The median really doesn't matter too much because in the end, we just get the average, right? We get the mean return. Interestingly enough, when the RSI is neutral, so it's between 30 and 70, the mean return is very comparable. So when the RSI is very low, we tend to see the same kind of performance almost compared to buying in the neutral zone. It's right around 10%. But have a look at this, the overbought category. This is when the RSI is high. Both the mean return and the median return is much, much higher. And that's really why we've got this positive correlation here. It's not because we've got negative returns when the RSI is low. It's because we tend to have much more positive returns when the RSI is high. So fundamentally, what we are saying here is when the RSI is low, when everybody thinks that we are oversold, we are actually just neutral. We just tend to make the same kind of return in the future. But when the RSI is very high, and some bearish analysts might say that now we are overbought, that's something not to follow. When the RSI is high, we have a high likelihood that we continue to rise. We should rather treat this as a breakout opportunity. In other words, when we look at this chart, we should not look at both thresholds for the RSI, the 70 and the 30. The lower threshold really doesn't matter that much. We should only look at the upper threshold. When we go above the upper threshold, when apparently we are overbought, it makes sense to buy. It makes sense to hold for the next 81 days. And that is true through a time period where Bitcoin's number of active addresses did not go up anymore, and where Bitcoin did not outperform tech stocks anymore, and where Bitcoin did not outperform gold anymore. We were at a relatively neutral investing phase. Bitcoin was not in a massive bull market, it was rather neutral, and still the upper RSI signals are much more useful. In other words, when we break out above, when we get a signal like this, we want to hold for the next 81 days. And we tend to make money with that. How often does this work? The answer is historically, over that time period that we backtested, it works in 83% of cases. When we're neutral or oversold, we are close to the 50% mark. But when we are overbought, when the RSI is high, we have a much higher winning rate. It's not 100%. So obviously, there are cases where we still don't make money. And a lot of those cases have just been recently, right? If you bought over here, the RSI level is very high, and then you're selling after 81 days, you lost in this particular instance. But that's exactly why we make those back tests, why we run the numbers. It's to find market structure anomalies that aren't that obvious to the average investor. And 83% of a win rate is massive, and a median return of 21% and an average return of 42% is massive. And I also think it's quite counterintuitive that after a signal, the position should be held for 81 days, right? Most people are going to trade much more actively. But really, the highest R squared, or the best fitting of the regression relative to the data points, is for the subsequent 81 days. And so this is where this channel is very different to most other crypto channels, right? Other crypto channels just look at the indicators, they take the common interpretation, they don't even know how well the indicator works. They're not really testing their thesis, they're not really testing their approaches. But I like to figure out how good does a trading rule work, because I want to trade based on rules. I do not think it's that good to trade just based on gut feeling. It's better to determine rules that historically worked well and simply then follow those rules. If you're interested to get access to this platform where I'm sharing my most profitable strategies, but where you can also run your own backtests, right? You click here, create backtest, you select your asset, you select what you want to do, you want to optimize the simple moving average or any other indicator like the RSI. Or if you want to backtest indicator combinations, right? What happens if we are, say, above a moving average and at the same time we are at the higher end of the relative strength indicator? What's actually the best combination of those two moving averages? All of this can be done with this tool. It's available for the premium members. The link is down below. If you got some value out of this video, feel free to give it a like. It helps the channel grow. Feel free to also subscribe. I publish videos regularly. I try to be as data-driven as possible. Looking forward to seeing you next time on YouTube, or of course in premium as well. Cheers.